Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, here we are, Jim. It's Friday, and we're seeing a little correction in the stock market thing here today.
We have a couple of listener questions. We have Justin in Berkeley. His question to us, Bob. Hi, Mish Shedlock recently posted an image of the M1, M2 money supply charts. The M1 chart is a straight vertical line this year, which is getting a lot of inflationists excited. But if money supply really had an effect on the economy, wouldn't gas be at $1,000 a gallon by now? That would be, $250 a liter. Yeah. It almost is in Vancouver with our, the biggest tax load on a liter of gasoline in North America. Yep. The Fed cites that these measurements are useless, though, and they don't track it consistently anymore. Well, my question to Bob is, isn't most of this credit and money creation just vaporized on contact, trying to keep asset prices level or rising, like pumping a tire which has a leak? And what happens to assets when quantitative easing, printing, and cheap credit stops?
Right.
Well, so what happens when the printing presses, which don't really exist, stop because they just pressed a button and somehow, $1 trillion is created?
Yeah, well, that's the way it is. Now, Mish does some pretty good work, but there's, they define money supply, M1, M2. Hell, when you look at the definitions, and this is beyond cash, which is money, these definitions are really credit. There should be C1, C2, etc. And but what you have is, of course, with the central bank being very reckless, and it's been reckless for a long time, and then with the new Marxist administration, the inflationists are back, as Justin, as you point out. But the question is, will all of this juice that's going into the market drive commodity prices higher, which would then get you into possibly wage inflation and all that sort of stuff? And I don't think so. We're going to stay with history on this one, is that the central bank needs speculation out there in order to push credit out the door. And here's where it gets really interesting, because in one era or one decade, when the Fed is recklessly pushing out credit, the speculation will be in commodities, like in the 1970s or back in 2008 and 2011. But then you get another decade where the inflation is in financial assets and the money supply grows. So what I've done is looked at all of the great financial booms in history, starting with the first one, the South Sea Bubble in 1720, and the setup has been similar. A decade of inflation that we know, and then a decade of inflation in financial assets, which most economists and central bankers still don't understand. So the huge commodity boom in 1920 was global, and everybody was uptight about inflation, and then it went from plus 24% CPI inflation annually in 1920 to 1921, where it was minus 16. So then the Fed spent the 1920s extra easy because they were worried about not enough inflation. But they didn't understand that the inflation was happening in stock and bond prices, and then it was over. So then you move forward to the last decade, And as we all know, the Fed has been chronically worried about not enough inflation and has been unusually easy. And the big action has been in stocks and bonds and of recent in commodities. So we just take this as this year has been the likely year that the bubble would complete. And also on every bubble, as 1929, you also had rallies going on in basic commodities, which we have. Now, for example, right now, as today on corn, we've got special sell signals on this thing. The move has been outstanding, but it's now in the market. So here's the wrap on inflation is that it's that the old-fashioned 1970s inflation is going to happen is in the market. What we have, the real big inflation, is in financial assets, stocks and bonds, and for 300 years, whenever the inflation is in financial assets, creates a bubble. The bubble climaxes, which it could be doing now, and then the crash. And in every case, inflation and financial assets has been followed by deflation in most everything, except for gold's real price. Now, here's the other one, is he asked about whether I like the term, is that the credit and money creation just vaporizes. Yeah, and this is where you get to the very elusive concept of velocity, money velocity. And when it's going for you, and it goes for you in a party, and then when the party's over, velocity hits and denies the attempts by the Fed to extend credit and keep the bubble going. So, good question. Thanks.
And our follow-up question here from Frank, it's like Frank knew you were going to be answering that question. Rabobank is talking about a biblical commodity price increase scenario in soft commodities. Grains, that would be corn, have been in a solid uptrend the last few months, but so has pretty much everything else. How much of this rise is due to supply-demand imbalances, and how much is due to the mania that has infected Wall Street? Do you expect soft commodities to be punished by the post-bubble contraction?
Thanks a lot, Frank. Yeah. The agriculture's beginning about 3 years ago, and the ag index we follow was down to about 275, and I was looking at the cooling in the climate, and that this was beginning to shorten the growing season in the northern hemisphere. And I thought, gee, this is going to force ag prices up. But it wasn't until last year when that index was down to about 255 when my colleague Ross got the technicals on it and had the buy. Well, it's that ag index is really soared. It's done very well. And also, the growing seasons have been shortening. And there was a headline on that just the other day. And it's not just in the grain belt in North America, but in Ukraine. It's another grain belt in Ukraine and Poland, and it's there as well. So, yeah, but at the moment, the agricultural prices are becoming overbought, and as I mentioned, corn is specifically straight up, and it is now giving very strong sell signals. So we'll see what happens with there, but it's certainly a timely question, and what one wants to look at in these soft commodities is perhaps corn is leading. There's the others, and we can take a look at those at one at a time as the opportunity comes by. But Frank, very timely question.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob will be taking a look at some headlines. One of the headlines that caught my attention was in the Globe and Mail today. It says, sell in May means it's time to get defensive. And Mark Leibovit, friend of the show, said yesterday, this may be a sell in May and go away year. What's your feeling on that?
Oh, yeah. There's, on top of that, in January we updated a study whereby on any great boom you get huge growth in margin, outstanding margin in the New York Stock Exchange. And in November this got up to a certain key rate of change on the upside, such that this was another researcher, but we updated it, that about 6 months later is likely the time for the peak, which would be, counts out to May. So on this model, and then it's traditional in all of the great financial booms in history, going back to 1720, as they occurred in England and London, the peaks were in May or June. So it's a timely period for if it's hot, and it is hot, you just take some money off the table.
Another headline that caught your eye, China economy booming. Well, of course, we know China, every time they set an economic goal, a year later, they've always exactly hit their 6.752177% increase.
Yep. Boom stuff. And then there was another one with Lakeside, Idaho City as America's hottest housing market, and home prices are surging the most since 2006. So these headlines are the boom headlines, and this is the maturing story. And then you've got, Jim, the other kind of headlines where the adverse is beginning to come in. And we've got the one where the administration is talking about capital gains tax. A prominent economist says it's tax insanity. And then you've got Credit Suisse shareholders are out to get the risk chief guy because it's been so much of a disaster there. That was in the one we've been talking about for months, where this company called Greensill got overextended and lots of people are having problems. So, hey, it's the markets.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, the Canadian dollar well over 80 cents. Why is the Canadian dollar doing so well? Is it a case of the U.S. dollar falling, other currencies struggling? Why would the Canuck buck be doing well when, our national deficit's at a record high and it's more than $1 trillion in debt when you come to just the government?
Oh, well, all governments are mad. And it's the commodity currency. Commodities go up, so does the Canadian dollar. But as we noted, some of the commodities are getting a little overbought. The action in commodities was expected to be favorable into about mid-year, which it has been, and thus the Canadian dollar action is favorable as well. But somewhere after mid-year, you then have seasonal forces working on commodities. For example, you got lumber going straight up, $1,400. And it can often have a seasonal high in June, and then a seasonal low in October. You can have a seasonal high for copper in July, and copper's going up. So somewhere by mid-year, we've had a target that commodities could peak out, And then in August, we'll start emphasizing that these things can have important seasonal lows later on in the year. So it's going to be very, very interesting.
Is the U.S. dollar going to rise or fall?
Oh, it's building a long base in here, Jim. It's in a pattern. This base can run about 4 months. And then upon basing, and it gets above the 20-week moving average, that would say that the base is completed. And then the other would be that getting up yet to a higher price sets the uptrend. And we would just note that in previous financial contractions, liquidity crisis, the U.S. dollar has gone up during the crisis. So it reaches a low as the speculation is booming, and then in the contraction, the dollar will go up.
Interest rates, Bob, a friend of the show, Danielle Park, yesterday saying low interest rates are very damaging to banks, insurance companies, and especially to pensioners who are expecting to make 4 to 8% on their savings, and they're not right now, so they're forced to make risky investments that could lose everything for them. The central banks seem dead set on keeping interest rates low. Can they and should they?
Oh, this is evil, forcing rates artificially low. It forces people to, for yield, to get into highly risky things. This will eventually goes down as one of the greatest policy disasters in history. And I'm very much against it. Daniel has got a good eye for that. And the policymakers, and unfortunately the public, will soon be paying for their absolutely reckless pursuit of theories that have never worked. So I'll be glad to see when it's over.
And Bob, before we go, chartsandmarkets.com has a special offer for our listeners.
Yeah, I guess we could call it for May the 1st Communist Day. So we are, it's 25% off the regular annual subscription, and it's a good deal.
Bob, how can people find out about it?
Our regular thing, you can get in touch with me, bobhoye.com, or Bob Hoye, or Charts and Markets. It's all there.
Thanks a lot, Bob.
Very good, and we look forward to talking to him next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, he loves to answer them. Send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.